The hour of 8 a.m. having arrived, I'm going to call the Taxes Committee to order. We do have a quorum. Thank you, members. And we have some minutes from Thursday, February 20th, 2020 to approve 2/20/2020 minutes. Representative Les Lagarde moves approval of the February 20th, 2020 minutes. Any discussion on that? Hearing none, I'll call for the vote. All those in favor say aye. Aye. Those opposed say nay. Motion does prevail. The minutes of February 20th, 2020 are approved. So, members, today we have Eric Willett from the Department of Revenue to look at the tax expenditure budget. This is not something that is new to this committee. We've talked some tax expenditures before in the past. And so, Mr. Willett, I'm going to have you go over the slides and the presentation. And members, if we could hold our questions to the end, and then I think we'll open it up at that point. So, Mr. Willett, thank you for being here, and please proceed and identify yourself.
Thank you, Mr. Chair, members of the committee. My name is Eric Willett. I'm the Tax Research Director at the Minnesota Department of Revenue. I'm here to share with you some of the tax expenditure budget. This is a report mandated by statute that we do every 2 years. It's prepared by the Tax Research Division. The Tax Research Division does a variety of research on tax issues that helps you and other policymakers, including the revenue estimates that you see when you're hearing bills, the tax incidence study that we do in the years that we're not doing the tax expenditure budget, the Minnesota Tax Handbook that many of you may have seen, and a number of other resources on the department's website. This is the 17th tax expenditure budget that the Tax Research Division has done. It's due February 1st of every even-numbered year. We released this one January 31st, so we got in just under the wire. It's a very big project for my division and for the Property Tax Research Group. In total, 15 analysts and an intern worked through the summer and the fall to prepare the 312 tax expenditures that are contained in the report. The report was guided by Randy Sanford, Curtis Walker, and Nick Green. Yeah, so I'd like to start by talking about the tax expenditure as a concept. What is a tax expenditure? How do we define it for the purposes of this report? Then I'd like to walk through some of the sort of 3 different main uses of the report, ways that you and your predecessors have found this report helpful in your work. And then I'd like to end up with some comments on recent changes. So why do a tax expenditure budget? Like with everything we do at Tax Research, it's to provide information on which sound policy decisions can be made. I'm going to talk about some income tax examples to help illustrate what we think of a tax expenditure. So if the only purpose of the tax system was to raise revenue, then many economists would tell you it makes the most sense to have the broadest base possible and the lowest rates possible. But we ask our tax system to do a whole lot more than just raise revenue. We want to encourage home ownership, so in the income tax system we have the mortgage interest deduction. We want to help pay for child care, so we have a child care credit. We want to recognize and reward combat veterans, so we have a combat credit. We want to increase business startup funds, so we have the angel investment credit. We want to help beginning farmers buy land and other farm assets, so we have the beginning farmer credit. So all of these things can be thought of as tax expenditures, and I'll get into a formal definition in a minute. But I want to first say that for the purposes of the report, we don't consider a tax expenditure. We consider the idea of a tax expenditure to be a value-neutral thing. By naming something a tax expenditure doesn't say it's a good thing or a bad thing. It's just part of our tax system that is an exception to a general rule. Okay, so it's important to think about what a tax expenditure is by juxtaposing it to direct expenditures, which all your finance committees focus on. So some of the differences between tax expenditures and direct expenditures include that there's no specific line item in the state budget for tax expenditures. They're just baked into what the totals are for the various tax revenues that you see on the spreadsheet. There's also no regular review process. Many of the spending programs in the state are renewed every 2 years through the biennial budget process, so they are scrutinized through that process. Tax expenditures don't have that formal review process unless you or another committee decides to take a special look at them. There's generally no limit on growth over time for most of these. So if it's a tax expenditure that grants a preference for an activity that's growing over time, the tax expenditure is going to just keep growing and erode the base of whatever tax it applies to. Authorized by different committees, tax expenditures are the purview of this committee, whereas direct spending is, other than some property taxation credits, are generally the purview of the finance committees. There's generally more limited public access to information about tax expenditures. Most tax information, especially with the big taxes in Minnesota, is all non-public information. So it may be harder for citizens and policymakers to scrutinize the effects of tax expenditures in comparison with direct spending programs. And there's also an important difference of perspective. A tax expenditure reduces taxes, whereas a direct expenditure increases spending. And there's a difference in perception between whether you can achieve an end by reducing taxes as opposed to trying to do the same thing through increasing spending of government. So that gives tax expenditures a different set of pros and cons for policymakers. So as I said, there's 312 tax expenditures in the report, and you see a list by tax type. The bulk of them are in the individual income tax and the sales tax areas, with the corporate franchise tax being the third most. Within the sales tax, there's also one tax expenditure item called select services that's actually a table on page, it's item 4.18, page 116 of the report. It's actually more than 30 separate items just put together in a table. So you could say that there's 340 tax expenditures in the report. So I just want to walk through an example of what you see when you open a page. I'm going to use the home mortgage interest. That's number 1.67 on page 64 of the report. And all the most of the tax expenditures have the same look and feel, so I'll just tell you what the components of each one is. So first at the top, after the name, you've got the legal citation. So where in the statute is this tax expenditure authorized? Then you've got a description of the current law, sort of how it works in very brief form. And then the next section is a brief history, if there's been some major changes to the tax expenditure over time. Then we add the number of taxpayers affected, where we can identify that in a recent year. And finally, at the bottom, we have a dollar impact. So in this example, the home mortgage interest is estimated in 2020 to reduce individual income tax receipts by about $83.4 million. Now, those of you who have seen previous reports will know that this is quite a bit lower than in the past report. Among the changes that were made in the 2019 tax bill, we had a significant reduction in the number of taxpayers who itemize, and I will highlight that those changes in a little bit. Okay, so what is the formal definition of a tax expenditure? So there is some difference among tax expenditure reports and tax practitioners on how they define tax expenditures. Some of it is open to some debate, but for the purposes of this report, something is a tax expenditure for the purposes of this report only if it meets 7 different criteria. So the tax applies statewide. So it's a broad-based tax, so we exclude local taxes from the tax expenditure budget, except for the local property tax, which has statewide uniform rules around it. Oops. There we go. It provides preferential treatment, so some taxpayers are advantaged by the tax expenditure, but some are not. It has a revenue impact. So somebody is actually getting a dollar benefit out of it. So an example of this one where it doesn't always show up in the report is the tax exemption for Super Bowl admission. This appeared in a report many years ago, then it went away for a while, then it was in the last report because we hosted the Super Bowl once again and the expenditure was still in the book. We've omitted from the report this year because in the current forecast window, we don't anticipate hosting the Super Bowl again. But perhaps it will come back again sometime, and we'll put it right back in the report when it does. So it also includes provisions that defer a tax rather than exempting a tax. So all the timing provisions are included, many of the timing provisions for depreciation and such and expensing are included in the tax expenditure budget. It is not subject to an alternative tax, so there are some parts of the tax code where we exempt certain businesses or activity from one tax, but they pay another tax instead. There's a cigarette in lieu of sales tax, so there's no direct sales tax applied to cigarettes. It's paid at the wholesale level. Similarly, for motor vehicle, solid waste, and lottery tickets, there's an in lieu of tax that replaces the main tax. And it's also not included in the tax expenditure budget if it's counted as a direct expenditure elsewhere in the budget. The property tax aids and credits that I mentioned earlier are not in here because they are part of the regular budgeting process. It's also a tax expenditure only if the legislature has the authority to impose the tax. So there are some exemptions that are built into the Minnesota Constitution, federal law, the federal Constitution, and since this body doesn't have the authority to remove them, we do not include the impacts of those in the tax expenditure budget. So examples of that are the income tax exemption for federal bond interest. You couldn't tax that legally even if you desired to because that's preempted by federal law. And some property tax exemptions for schools and churches are exempted by the Minnesota Constitution, federal land by federal law. Finally, it's a tax expenditure if it's included in the definition of a tax base. And this is the one that gets a little bit more nuanced. So at the beginning of each chapter for each different tax, there's a definition of how we define the tax base for the purposes of tax expenditures, and anything that deviates from that defined tax base can be a tax expenditure. So for the purposes of the individual income tax, income from all sources less expenses that are reasonable and necessary to generate that income is the natural tax base. Anything that deviates from that is a tax expenditure. So deductions are allowed that go beyond regular depreciation because regular depreciation is considered part of the expense of earning the income. Personal dependent exemptions, the standard deduction, the tax rate structure, we consider to be part of the regular tax base because all taxpayers fall into one of the buckets and all income that's from similarly situated taxpayers is taxed at the same rate. For corporate tax, equal weighted apportionment and the throwback rule are considered to be part of a regular tax base. When we deviate from those, it's considered a tax expenditure. The sales tax base, for the purposes of our report, includes all final purchases of tangible goods and services. And this is one of the areas where there's probably the most discussion about alternative ways. If you think of the sales tax as a pure consumption tax, then you would consider all taxes on business inputs to not be part of what the regular base should be. We have a lot of taxation of business inputs in Minnesota. So for the purposes of our report, we do consider some of those to be tax expenditures so we can illustrate them in the budget and give you an opportunity to give some scrutiny to those items. But that is one where there's a lot of disagreement about what is really the proper definition of what the base is for the sales tax. Okay, I'd like to walk through three different uses of the tax expenditure budget. Oh, I'm sorry, I didn't advance the slides. You've got them printed. So I'll walk through three different ways to sort of think about how you might use this document. One is from a budget perspective, in terms of helping you compare the effectiveness of direct expenditures and tax expenditures that have a similar purpose. A tax reform perspective, can we use this to think about an approach to broadening a base and reducing the rates? Or a revenue perspective, can we come up with ideas if we need revenue increases by looking at existing tax expenditures? So I'll describe each of these in some detail to help you think about how to get the most use out of this out of this budget. So I want to refer to some work that was done in 2011. There was a review of tax expenditures facilitated by the department where we brought in some local economists to sort of look at what we do in the tax expenditure budget and what the legislature might want to do beyond that to facilitate a more thorough bringing of the tax expenditures into the regular budget process for the legislature. So after a lot of discussion about how we define things in the budget and some recommendations on that, they talked about if the legislature and governor wanted to sort of align tax expenditure budget with the regular budget, what could facilitate that? And the recommendations including having a formal commission that periodically reviews tax expenditures, and doing some evaluation of a certain number of them each year. And this commission recommended answering a number of questions. What is the goal? It may seem obvious, but many of the tax expenditures, if not most of them that are in statute, don't have a defined goal. Some of them have been in existence as long as the tax has been in existence, so they've never really been formally adopted as a separate tax expenditure. Others have been added, but were never defined what the purpose was. You can define some purpose by listening to testimony or looking at the historical archives, but even then, oftentimes different legislators have different reasons for supporting a tax expenditure, so a single goal may not be clear from the legislative testimony. So a first step in evaluating something is knowing what it's trying to accomplish. So that's something that is actually more difficult than you might imagine for some tax expenditures. A second question that could be asked is, can the tax expenditure be redesigned to achieve the goal in a more cost-effective or transparent way? So once you know what it's trying to do, then it's easier to evaluate how good it is at achieving that goal and at what cost in terms of taxes foregone, administrative complexity, and other criteria. Alternatively, could a direct expenditure program achieve the goal in a more cost-effective and transparent way? You know, as I mentioned earlier, different committees adopt and design direct spending programs than those that design and enact tax expenditures, and they may have different ideas of how to achieve that. And if you're in one committee, the tools before you are the ones that are available to that committee. So you may not be choosing the best way to achieve the policy goal if you're in the tax committee, because a direct spending program might be more effective, or vice versa if you're on a finance committee. The next question is, should existing direct expenditure programs with similar goals be better integrated with the tax expenditure? This is where it gets really complicated and potentially really interesting. Should we simultaneously review spending programs and tax expenditures that are attempting or appear to be attempting to achieve some of the same public policy goals? Among them is a more efficient and effective way to achieve the goals. That would, of course, involve coordination between not just committees in the legislature, but often agencies in the executive branch. So those conversations, while really valuable, can also get really complicated really fast, but worth asking. And finally, should the tax expenditure be expanded, modified, or repealed? The ultimate question when you do a review and a program evaluation is, you know, is it doing the right thing? If not, how do we change it? Do we modify it? Do we scrap it? Do we enhance it? And all these questions take thought and time and a lot of digging into the details. So those were all recommendations of the 2011 group. So coming back to the tax expenditure budget, we consider the tax expenditure budget as sort of the foundational information that you need before you launch a program evaluation of a tax expenditure. So there isn't any evaluation built into the tax expenditure. This is sort of the groundwork that lays, this is the foundation on which evaluation can be done. There have been more evaluation of tax expenditures in the past. In fact, your House research and fiscal staff have done it a couple times in the last decade, where they've looked at a couple dozen tax expenditures and done some evaluation, much of which ask some of the same questions that the that the 2011 group recommended. It includes a discussion of the objectives, but I think it's telling that most of them start out with saying, well, it isn't very clear what the objective is, but. And then they do a great job of taking whatever information is available to try and identify what the objectives are. For some of them, it's easier than for others, but even the staff who worked on those would tell you that the identifying the goal is not easy. They did identify related spending programs, so you could potentially look at more of the universe of efforts by the state government to affect a particular public problem. They looked at the distribution of benefits through work that we did. We did what's called an incidence analysis of these individual tax expenditures where it was appropriate, so we could say, of the beneficiaries, what is the income distribution of who's benefiting from particular tax expenditures. And then also made some attempts at identifying any evidence of effectiveness through looking at literature that's already been published or other existing performance measures that might be available. But again, mixed success in identifying good sources for that. So I think this was excellent work. I think it also implies that to do it thoroughly and to do it well takes a lot of resources and potentially will take new original research to really try and answer some of these questions. But as I said, this document is, I think, a good first step to help you see what the lay of the land is of what existing tax expenditures are and what, if any, of these seem to be trying to achieve the same public policy goal and which ones you as a committee may want to put some attention to. So I'd like to shift to the second perspective or use of the budget, which is tax reform. And to do that, I want to do a couple of examples with our three big taxes. So I first want to talk about the income tax. So when you think about using this for potential tax reform, what we're really talking about is the potential for removing or tightening tax expenditures to enable us to broaden the base and then either put those resources elsewhere or reduce the overall rate to have a broader base and a lower rate. So when I say tax reform, that's kind of the tax change that's being contemplated here. But while this gets you, this report is really helpful for spurring that conversation, there are some sort of caveats and cautions that you need to think about when you're looking at the report. First off, there are some tax expenditures that it may not really be a good idea to think about repealing if you're thinking about tax reform. For example, some tax expenditures actually simplify the tax system rather than complicate the tax system. For the income tax, a lot of the provisions of the income tax, we piggyback on the federal income tax, which is really a convenience to the taxpayer and simplifies the Minnesota tax system. So wholesale repealing of all of those places where we're parallel with the federal tax would greatly complicate the work, could potentially greatly complicate the work of filling out your Minnesota state tax form. Similarly, all the timing provisions, as you all discussed when you were talking about tax conformity the last couple of years, decoupling from the timing provisions would create significant burdens for taxpayers and for the department in terms of requiring businesses to keep two sets of books for a very long period of time. So that's when you'd want to think really hard about before you would choose to use that as a base broadener for tax reform. So accelerated depreciation and such, and some of the retirement provisions probably are not ripe targets for reform. So you got to remember complexity both for the taxpayers and tax preparers and for the department when thinking about that kind of base broadening. Secondly, repeal of some tax expenditures could create compliance problems. So there are some things that are not taxed federally and they're not required to be reported federally that would make it very hard for both the taxpayer and us to comply with if we wanted to broaden the base with them. Examples, some employee fringe benefits and Medicare benefits, there isn't really an obvious place for the taxpayer and therefore the department to quantify those things. So probably not, that would be a very challenging thing to add to the tax base in base broadening. So I want to just take a really quick detour here because this seems like a good time to mention that another thing to think about with the tax expenditure budget is what data sources we rely on to come up with the expenditures. Whenever possible, we use data from Minnesota tax returns, because that's the most reliable, most accurate, and allows us to very carefully model what the impacts of the tax expenditure are. But there are a lot of federal piggyback type provisions where we don't have good specific comprehensive data on the impact on Minnesota returns. So we oftentimes will have to use the federal tax expenditure budget and just apportion to Minnesota, which introduces a certain level of estimation into it, because we know what Minnesota is typically a share of for federal provisions, but that's going to vary from provision to provision. There's somewhere we don't even have that data, and we have to estimate using a consumption model for sales tax provisions and some other federal economic data. So more caveats can apply to some of these provisions than for others. A final caution with the income tax interaction is that some of the provisions interact with each other. So simply summing up the dollar amounts for a bunch of provisions in the report will not necessarily get you what would show up on a revenue estimate if you simultaneously repealed multiple tax expenditures. The most obvious example of this is itemized deductions. What's shown in the tax expenditure budget is an estimate of the value of that tax expenditure in isolation. But if you repeal more than one of them at the same time, more and more taxpayers are going to reach the standard deduction, and then you'll get less total value than if you would add them both together. So if you simply summed items 1.64 to 1.69, which are the major itemized deductions, you would come up with $287 million in fiscal year 2020. But because of that interaction, if you repealed them all simultaneously, you would only raise revenue by about $191 million. So more than a third of the revenue would be lost because of that interaction amongst the provisions. Because we're talking about itemized deductions, I wanted to just highlight one of the major differences between the previous report and this report, which is the impact of the federal Tax Cuts and Jobs Act and the actions you all took to align our tax system with that on itemized deductions. So this table shows the estimate of 2018 from the previous report and the estimate of 2020 from the current report for the various itemized deductions, and you can see how much the cost of them or the revenue raising from eliminating them went down because of the law change. Because you increased the standard deduction significantly, the number of itemizers was greatly reduced. In 2017, over 1 million of our filers itemized. In 2019, we estimate that only less than 200,000 of our filers will itemize. So only under 7% of filers we expect to be itemizers in 2019. And because of that, many fewer people are taking advantage of these tax expenditures. The $10,000 limit on the property tax and other tax deduction also added a layer of reducing the power of those itemized deductions for many taxpayers. Even if they're still itemizing, they're able to itemize less if they have taxes in property and other state property taxes that exceed $10,000. On the other side, because a lot of people switch from itemization to the standard deduction, many more of our filers are eligible for the charitable subtraction, which is the alternative to the itemized deduction for charitable contributions. And you can see that our estimate is that will increase from 212,000 filers to 750,000 filers, and the dollars increasing accordingly. So a lot more taxpayers are going to be able to take advantage of that tax provision. Okay, so just to kind of bring together some of the things I've talked about, this is the individual income tax, and at its broadest, if we eliminated all the individual income tax tax expenditures, we estimate that the existing rate structure would raise just over $19 billion, which means there's about $6.7 billion of reduction because of the various tax expenditures, and the net revenue in fiscal 20 is estimated to be $12.5 billion. So that's $6.7 billion of tax expenditures is equal to about 50% of the actual collections. So in theory, if you wanted to have an absolutely flat tax system with no tax preferences and the existing rate structure, you could increase revenues by 50% or reduce the rate structure equivalently to reduce revenues by that amount. But I mentioned that many of them have that would add so much complexity that it's probably not a good idea, or you'd have to be very careful in how you would expand the base. So this chart also splits that $6.7 billion into the share where repealing them wouldn't pose significant burdens on taxpayers versus those that would. And as you can see, that that $6.7 billion quickly becomes only $1.4 billion of expansion or revenue available to reduce rates if you take off the table all the ones that really would create headaches for the taxpayers. A parallel chart for corporate tax. So the corporate tax has fewer preferences as a percent of the, I'm sorry, actually more preferences as a percent of the total. So the corporate tax for 2020 is estimated to bring in $1.5 billion. If we eliminated all tax expenditures on the corporate tax, it could raise almost $2.4 billion. So those tax expenditures represent 60% of existing collections. Unlike the individual income tax, most of these, the majority of these would not pose the kind of bookkeeping and other headaches, compliance headaches that we talked about with the individual. So much of that could theoretically be used for tax reform. But again, all tax expenditures have a purpose, some of them probably very good and highly valued. So I'm not implying that this is a good and the right thing to do and you should pass this tomorrow. Just the sort of extreme illustration to see what share of the total base is in tax expenditures. A little bit about the sales tax. So again, the sales tax also has a lot of tax expenditures that represent a big share of the base, but it also comes with some cautions about looking at all the tax expenditures in the report. I had talked about the definitional issue of how we consider the tax base to be sale of tangible personal property or services to the final user. And in many cases, businesses are the final user under that definition. But a lot of economists and policymakers think that it's not a good idea to tax business inputs because it creates tax pyramiding. And that is, the business will pay sales tax on the capital equipment, and then whatever they're producing will turn around and have sales tax applied to the final price. So there's sort of a element of double taxation in that situation. So you'll want to think hard about whether tax expenditures that exempt business inputs are low-hanging fruit or not, if that would create additional tax pyramiding beyond what already exists in our tax system. The tax expenditure budget also includes selected services, but there are some services that we don't include in the report historically for data issues, including some big ones like medical, educational, housing, and construction sales. These are ones that we could potentially provide estimated information if that's of interest, but they are not included in the report. So just a caution there. So here's that similar table that you saw for income and corporate tax for the sales tax. The tax expenditures in total represent almost $8 billion of potential revenue if we were to apply the sales tax as an incredibly broad consumption tax. And that represents actually more base than what is actually taxed to get to $6.3 billion of net revenue for fiscal 20. If you wanted to focus just on the purchases for consumers, then you're talking about 57% of existing collections. So you could potentially increase the $6.3 billion to almost $10 billion if you taxed virtually all consumer services. And again, there's maybe very good reasons not to do that, but just illustrating what the ceiling is on broadening the base, focusing just on consumer consumer spending. Finally, the third perspective I want to talk about is the revenue one, which is sometimes maybe the first one some people go to in grabbing the report, which is just to raise their eyes and say, wow, we could raise X million dollars if we eliminated this tax expenditure. But again, there's really important caveats that you need to think about if you're going to use the tax expenditure budget in that way. We do formal revenue estimates when there's a proposal to eliminate a tax expenditure, and those revenue estimates take into a lot of things that the tax expenditure budget doesn't. So you need to take the tax expenditure budgets with a grain of salt before using those as sort of a budget target. The individual items ignore interactions among items, like the example I gave with the itemized deductions. The sum of the total isn't what you would get in a revenue estimate. It also ignores impacts on other taxes. For example, vehicle registration taxes have an impact on income tax collections because they're a deductible tax. So that would show up in a revenue estimate, but it doesn't show up in the tax expenditure budget. Property tax items have income and property tax refund interactions that don't show up in the tax expenditure budget. Don't adjust for effective dates. You have to have a starting date that probably takes some lead time with most law changes. That's not taken into account in the tax expenditure budget. It doesn't take collectability into account. There are some tax expenditure items, even if you repealed them, the department and taxpayers would be hard pressed to comply with them, so there might be some collectability issues that would reduce the ultimate revenue raised. For example, occasional sales. Even if you repealed the sales tax exemption on occasional sales, chances are many, if not most, garage sales and lemonade stands wouldn't be remitting sales tax, at least not on a timely basis. And so that's not one that probably is low-hanging fruit for a revenue raiser if you're looking for them. And unlike revenue estimates, the tax expenditure budget is only updated every 2 years. So every forecast, there could be more recent information that would provide you more accurate information on the impact of a law change. And always remember administrative complexity. There's going to be a trade-off to any change of the tax system in terms of burden of the taxpayers, cost changes to the department. I want to talk a little bit about the property tax chapter because that's different from all the other ones in the report. And if you're just skimming the report, it takes a little bit of mental adjusting to kind of soak it in. So for the other tax expenditures, the tax expenditure is measuring the taxes that would be raised by state government if the expenditure was eliminated. The property tax, because it's a levy-based tax, if you eliminated some of these preferences, we assume that the local government levies and the state general levy would remain the same. So what we illustrate in the property tax system is the tax shifting away from other property onto the property that had been benefiting from the tax expenditure. So it's more about the shift among property taxpayers than it is about raising more or less revenue. And on page 188 and 189 is one of the biggest of the property tax expenditures, which is the classification system. As those of you who serve on the property tax division or know something about property taxes, Minnesota classifies the property tax by the type by the use of the property. So what share of the value of a property is taxed for property tax purposes is different for business property than it is for a home or a farm. And it weights different property types, which means it changes the tax base from what it would be if it were just purely based on the assessed market value of the property. And what the classification system shows on the tax expenditure budget is if we took all the existing levies and levied them against assessed market value instead of against net tax capacity or referendum market value or the state property tax levy, how would the taxes shift from benefiting properties onto a non-benefiting property? And the upshot is that the classification system generally benefits farms and residential homesteads at the expense of business property. But there's a lot of nuance in the shifts that's shown in the tax expenditure budget. So again, the property tax chapter shows shifts rather than absolute change in revenue. Similarly, a lot of property is exempted from the property tax. And again, this just shows the statutory exemptions that you have the authority to eliminate. So schools and churches and other religious institutions, for example, are not included in the tax expenditure budget. But this shows if they became taxable, how much tax would shift off of the currently property onto the tax exempt property. And it's about $900 million of property tax in 2020. Again, agnostic on the good idea or bad idea, but illustrating what the impact would be. So I just want to do a couple concluding comments, and then I'd be happy to take any questions that you have. So in summary, the tax expenditure is useful for thinking about budget reform, looking at comparing budgets and direct spending and tax expenditures. It can be assist you in sort of base broadening tax reform thoughts, and it can also serve as an idea generator for potential revenue increases for either spending increases or rate reductions. I encourage anyone who's interested to read the very short introduction. It gives sort of it kind of reiterates a lot of the points I made about the conceptual basis for what we think of the tax expenditure, and also we'll raise some questions about how to best use this report. And then just also keep in mind all the caveats that I gave, and know that our team and the PrepTex research team are available for more formal revenue estimates if you're considering an actual bill to change any of these tax expenditures. Final note, just a couple of, highlighting a couple of changes. We only had one new enacted tax expenditure since the last report, which is the aquatic herbicide sales tax exemption. Oftentimes the list is much longer, so only one added this time. One was extended that would have gone away, which was the angel tax credit. And then, as I mentioned, one that's dropped because it's currently inactive, which is the Super Bowl ticket admission sales tax exemption. And there were some other changes in terms of the order of magnitude, like because of the law changes for the itemized deductions, the Wayfair impacted some of the sales tax provisions, and there are some others that had changes due to economic trends or changes in the federal estimates in the federal tax expenditure budget or some other things. We were the 10th state to adopt a tax expenditure budget, and that was in 1983 when it was first authorized by the legislature and the governor. Now 47 states and the District of Columbia have tax expenditure budgets. Many of them are not as thorough as ours, and ours was one that was highlighted a number of years ago now as one that is a good model for other states. And I know from talking with a lot of my colleagues from other states that a lot of them look to ours to get ideas for how to do theirs, which isn't to say that ours is perfect, because there are things that other states do with their tax expenditure budgets that ours does not. As of a few years ago, a dozen states organized the tax expenditures by category, spending category, rather than tax type. And we've done some conceptual work on coming up with a table that you can order by that, but we haven't finalized it, partly because of the ambiguity of some of the goals. There might be some discussion necessary to actually decide which expenditures belong, tax expenditures belong in which spending category or policy category. Some states list a purpose or rationale for each tax expenditure. Again, we don't have purposes identified for many of them, but that's something that a dozen states do. Some states do more formal evaluation of expenditures, but not many as far as we can tell because of the resource intensiveness of doing program evaluation. Many do one-offs, as we have done. The OLA did a look at our research and development credit a few years ago, and as I mentioned, House Research did some good work a few years ago looking at some tax expenditures. So with that context, I thank you for your time, and we'll be happy to try and answer any questions that you have.
Mr. Willett, thank you very much for this information, excellent information. Quite frankly, without this report from the Department of Revenue every 2 years, we would have no idea how much is being spent on tax expenditures, unlike every other area of the budget where you see line items of what's, if this report was not being done, we'd just be, we'd be in the dark, absolutely. And so I just had just a quick question before opening up to others, but Mr. Willett, do you know what year it was when we began requiring purpose statements on the tax expenditure? How long ago was that? And it's not always done, I don't think, but Mr. Willett?
Mr. Chair and members, I believe 2011, at the same time the Review Commission was established, that was also put into statute, that any new or changed tax expenditure requires a purpose statement. So if that were faithfully done over time, we would start having a body of goals identified that we could use to put into the report.
And the one last comment I'll make before we open to questions is, you listed here Oregon, Minnesota, and District of Columbia known as good reports. I just read something from the Tax Policy Center, and they only mentioned Minnesota and DC. So the bottom line is that thank the staff and all those who helped put this together, because Minnesota actually does really a good job in kind of getting this information out comparison to the rest of the nation. So thank you to the department, all those folks who helped put this together. So Representative Carlson L. had a question.
Mr. Chairman, during my relatively short tenure in the legislature, we've always debated how our budget expenditures compare with other states. And I think when you talk to the average citizen, most of these tax expenditures, they don't view them, at least in their vocabulary, as an expenditure. They view them as tax relief. And yet that has an impact on how you perceive the overall state spending. And I guess where I'm headed with that, some of the comments that were made in the presentation, for example, how tax-exempt property is treated in Minnesota perhaps as to other states, or the various exemptions in the sales tax and so on, and how that varies with other states. My point is, I think you have to almost compare, if you're going to get into that debate about our budget and how it compares with other states, is you have to look at the tax expenditures and how that varies, because an awful lot of that budget is in fact an expenditure / I'll say tax relief. If I'm talking to a constituent, they're not going to use the term tax expenditure. They're going to talk about tax relief. And yet we calculate it with our accounting system as a tax expenditure. And I think that kind of confuses the size of the state budget when you're comparing us with our neighboring states or even nationally.
Good.
So it's not really a question, it's just a comment.
Yeah. Anyone else on this part right here? If folks were to go through all the tax expenditures, it would remind me of a couple of other efforts where it looks like there's always this low-hanging fruit, and then you start looking at each and every one, and you say, oh, I don't know. But the same would be when we have people look at reducing property tax classification. So, oh, that's an easy one. And then the report comes back with a couple minor ones, and those who are affected are sitting right where you are, Mr. Willett, talking about why we need to keep that. In another area that we've looked at, same thing, is all the mandates in special education. There's been committees that has looked at that, and we've got all this paperwork and that, and then they look at it and, well, this one's, everyone has a constituency, and so I appreciate the report. You're not saying putting a value on any of these, and there's certainly, probably most of them you wouldn't even think about probably doing much with. But it is worthy to take a look at all these to know the purpose and at least give it a light of day when you get into the budgeting process. Representative Carlson A.
Thank you, Mr. Chair. Mr. Willett, I appreciated your presentation. And I kept flipping back and forth between a few pages. Page 11, where it talks about bringing tax expenditures into the budget process, this tax expenditure review report of 2011, and the recommendations that were made there. You spent some time kind of going through the the questions that we should be asking, and I'm referring back then to page 7, where you kind of give an example of, just one of the tax expenditures in the report here. The idea of adding a goal or an objective is intriguing to me, and you spent some time kind of talking about other states that have done that and the complexities in terms of really trying to find neutral language to address that. And I can see why it's not a part of this report. But kind of the tax expenditure review report and this seem to kind of go hand in hand in terms of their one kind of supporting the other or answering questions that may arise. For myself and perhaps even newer legislators, is there like an index or a way in which those two documents could be utilized in such a fashion that could be even more helpful? There is so much information that's presented, and when your knowledge base is an inch deep and a mile wide on 1,000 different things, I'm kind of trying to cut to the chase on some of this, but I find that very compelling in terms of just asking those very poignant questions as we do our work. Any thoughts on that to kind of direct us in terms of other resources, I guess is my question.
Mr. Willett.
Mr. Chair and Representative Carlson, I think one of the biggest challenges with answering these questions is that many of them haven't been answered yet, so there isn't really a good crosswalk. The purpose statements, there are some now because of the 2011 law. That is something we could start to incorporate as they exist so that we sort of start slowly building them into the report. We could do what House Research did, which is speculate on the goals where there isn't one defined. That's getting a little bit beyond our expertise. To do it well, you need to do a legislative history to make sure you understand what the conversations were at the time they were enacted, and some of these were enacted 100 years ago. Some of that research could be intensive. It'd be very interesting and fun.
Yeah.
Something that, we're researchers. We love to try to answer those kind of questions. So I think there's work that could be done. I don't think there's a simple source to crosswalk to build it in. But I think the chair is right that because since 2011 they've been required and sometimes have actually been put into statute, there is some information that we could start incorporating into the report.
Excellent. Well,
Representative Carlson.
thank you, Mr. Chair. I thought the questions were quite thought-provoking, so I'll try to incorporate that into our discussion.
Representative Petersburg.
Thank you, Mr. Chair, and just to piggyback on what you said earlier, in regards to tax policy, it has a way, taxes has a way of creeping into our lives without us really noticing it. And so when we reduce the taxes, it's much easier for us to see than if it was never collected to begin with. And I think that's where the challenge is for us to know that just as I could lose a little weight at the beginning, it's going to be much tougher for me to change that than it is over the long term. So there's a short-term consequence and long-term consequences whenever we look at it. But again, the perception, and I think one of the reasons why we have automatic deductions of payroll taxes and so forth, because a little bit at a time you don't see it as much. If we were to all see it every year at the end of the year, it would seem like a much bigger deal. And when we reduce a tax that we collect, it seems to the average person, hey, we're getting a benefit to it rather than just not collecting it at all. So it is a perception issue that we have to deal with.
Anyone else?
Different words.
Representative Erickson.
Thank you, Mr. Chair, and thank you, Mr. Willett, for this very thorough and interesting expenditure report. How many staff does it take to keep track of all of these? I'm on page 159 now, and I'm just amazed at what has to be tracked. So how many staff do you have working on this?
Willett.
So, Mr. Chair and Representative Erickson, between tax research and property tax research, there were 15 analysts who worked on some of these, plus we had an intern over the summer, and then some supervisors who did some review of the work. This wasn't their full-time job. We have a lot of things we have to do in the interim to update our models and do other work, but it is a big undertaking. We start with the previous year's report, and we have set methodologies for most of these, so some of it is just updating data, but there's inevitably new ones where the data source has changed, so we have to figure out what's going on with them. So it's a lot of work, but it's very interesting work, and we're happy to do it.
Thank you, Mr. Chair. It probably wouldn't appeal to many of us, but I would imagine each division also has to have input because this report has, the different divisions also connected. So they have to keep track, I would imagine.
Mr. Willett?
Mr. Chair and Representative Erickson, with any tax bill, any law change, any new trend happening in the tax, the department has a legal team, it has the audit divisions or the administrative divisions, and us. We often have policy discussions around whatever the emerging issues are, so we can all track changes together.
Representative Erickson?
Thank you, Mr. Chair. Just one last question. How many employees do we have at the Department of Revenue?
Mr. Willett?
Mr. Chair, I'm about 1,400, I'm told by Assistant Commissioner Doty, who's in the crowd.
Representative Gomez?
Thank you, Mr. Chair. So I'm sorry, I'm a little confused. So in 2011, we passed a law that said you have to articulate the rationale or the intent of tax expenditures, but that only sometimes happens? And why is that? And how do we make sure that that isn't the way we do things moving forward?
Mr. Willett or Ms. Dalton? I don't.
You guys are all laughing. I don't
Okay,
understand why.
So the 2011 law was prospective, so all the existing tax expenditures, unless they're changed, they aren't required to have a purpose statement. I would say the simple answer to why it doesn't always happen is the notwithstanding clause. You all have the authority when you're passing a new law to decide whether you will follow that law or whether you will say, notwithstanding this law, we're not going to have an expenditure. But I'm sure Ms. Dalton has more to add.
Ms. Dalton?
Mr. Chair, Representative Gomez, the House has traditionally put those statements into the House omnibus tax bill. However, the Senate hasn't actually liked that law very much, and so they often don't make it into the final conference committee report.
That's Senate.
Throw that Senate under the bus. Where's that bus?
Thank you very much. Any other questions, Representative Gomez?
Just quickly, Mr. Chair, comment. I mean, I'm asking, it was interesting last year, you referenced the Office of the Legislative Auditor's report about the research and development tax credit. And that was sort of one of the most interesting things about the report was they were seemed like they're kind of casting about for trying to figure out what the actual intent of that pretty large, tax expenditure was. I'm interested to see that that's 50 million and the home mortgage interest deduction is 83 million, which I guess I think about how many people the mortgage interest deduction benefits, right, versus this sort of, comparably sized pot of money for research and development. So, yeah, so I guess I'm just found that really curious and interested in us figuring out how we articulate that really clearly moving forward when any of us bring forward, any of this tax spending. So thank you.
Yep, thank you. Anyone else? If not, Mr. Willett, thank you so much, and thank the staff for their wonderful report.
Thank you, Mr. Chair and members.
Yeah, thank you.
And Representative Fabian has a question unrelated to the tax expenditure. Representative Fabian.
Thank you, Mr. Chair. It does have one connection, and that is the slide on page 13, where it talks about decoupling from federal law would require 2 sets of books and so forth. So when I was home this weekend, Mr. Chair, and I'm going to ask Revenue to give us some information. I had a farmer in the area stop by my house with a folder of information on 179 and how Revenue is handling that. And we heard testimony recently about penalties and interest and how those are being applied to these accounts. or to these bills. And so to revenue, can you walk us through what you're doing with 179 and how people are being charged? I'm curious to know on the penalties and interest when they're assessed. And I see Ms. Bayers is here. Are those assessed when the initial letter is sent out to taxpayers, or after a period of time when they haven't made a payment and they're going through, what's the term that we used, abatement or something, trying to delay what's going on? And I've got a couple of other
I
questions,
think
Mr. Chair.
Ms. Bears might,
Yep.
would probably address that, talked a little bit about this when we had the Section 179 bills.
And,
but-
well, she's coming up, Mr. Chair. This is really disconcerting to a lot of people. I mean, there are not very many weeks that go by where people aren't coming to me and saying, I can't do this. And so anyway. So, Ms. Bayers, just to, if you want me to repeat my question, I'm happy to do that. Or if you've got it, let me know.
Mr.
Ms.
Chair,
Bears.
Representative Fabian, I think I have your question. For the record, my name is Joanna Bears. I'm the Legislative Director at the Minnesota Department of Revenue. And I believe your question was how the penalties are being handled when they
And
get an
interest.
assessment or we're doing an adjustment. So with the conformity, when we started doing adjustments, there may have been a penalty in the beginning. Taxpayers should have not received that penalty because we were trying to remove them before the assessment even went out. So that would have been like an underpayment penalty, the ATC charge, which is the additional tax charge. That's a self-reported penalty. And then after the fact, if there was, after the 60 days, when you get the assessment, you have 60 days to appeal or call us to set up some type of payment plan. If, after that 60 days, then we would send you a notice of a bill. You may have been assessed a penalty at that time, which then we are requesting people to call us to request an abatement. That's the one where we couldn't systematically remove it because we didn't know if the assessment was because of tax law changes or if it was because of other types of adjustments that were made not due to tax law changes. And then after that 30 days, if you didn't call it set up some type of payment plan or if you didn't pay in full, then there was, interest would apply on the remaining balance.
Representative Fabian.
Thank you, Mr. Chair. So, and I appreciate what we're trying to do here, but it seems obvious to me that that message is not getting through to some people. When I look through the correspondence, that, by the way, comes certified mail, all of a sudden, antennas go up, and I don't see the comments in here that helps to alleviate and minimize some of the anxiety that's going on out there. My constituents, and this is one farming operation, but of course, the way they've got it set up, they've got
Yeah.
3 different entities there, husband, wife, son, and so forth. So my main question is with regards to all of this, can taxpayers expect, until we get our work done, that penalties and interest are being waived in its entirety? Because that's what I seem to have heard in testimony, Mr. Chair, or not. Help me out here, so I can go back to folks in Northwest Minnesota and help them out. And you guys have been terrific when I've talked to you about this, and I've directed my constituents to get in touch with you folks. It's gone pretty well. So thank you for that, but there's still a lot of anxiety out there, especially with the way the farm economy is going, and they're trying to make financial plans, and bankers are nervous, and individual farmers are very nervous. They're not sure about their production loans and so forth. This is really a difficult situation.
So before you answer that, Ms. Bears, I do want to remind members that in last year's House tax bill, we had full conformity, retroactive on Section 179.
Yep.
We were the only plan out there that did that, which would have solved this. So I just want to remind members of that. Ms. Bears.
Mr. Chair, Representative Fabian, and I do hear your comments, and, we are more than welcome to work with taxpayers. They shouldn't receive a penalty, and if they do, that's when we're asking them to contact us. So if they're due to tax law changes, they should not have a penalty at all on their statement. Now, if they did not pay after we sent them a bill, there's interest that applies to the tax, but they should not have another penalty that's assessed on that.
Representative Fabian?
Thank you, Mr. Chair. So you will be charging some sort of interest, but not a quote penalty.
Ms. Bears?
Mr. Chair, Representative Fabian, if there's a payment plan set up or, the tax wasn't paid within the time frame, yes, there's interest that's on the tax.
Representative
Thank you,
Fabian?
Mr. Chair, and I appreciate your indulgence. Thanks. What is the interest rate?
Ms. Bears, do you?
Mr. Chair, Representative Fabian, I believe it's 5%.
Wow.
Representative Fabian?
Thank you, Mr. Chair. So how is that rate set?
Ms. Bears?
Mr. Chair, Representative Fabian, it's set every year. I believe, I would have to get back to you. Actually, I'd have to get back to you. I think that it's set statutorily, or it's set every year.
Mr. Willett,
Mr. Willett or Ms. Bears?
Mr. Chair, Representative Fabian, I'm told it's based on an average federal funds rate, so it is a formula that's set each year.
Thank you. I'll talk to you guys offline, okay?
And so, thank you, Representative Fabian. Representative Schultz?
Thank you, Chair Marquardt. So I have a question that you may not be able to answer, but if you could get back to me. How much tax benefit do we forego when people buy their health insurance through their employer and they use pre-tax income?
Are you looking at the tax expenditure for?
Yes, I don't
not
think
paying
I
tax
don't think
on
we
em-
collect it because it's a employer benefit. But I'm just wondering if we have that information, if you, and if you don't have it now, if you
So-
could get back to me.
The employer-provided benefit on healthcare, I think, is one of the biggest tax
It's
expenditures.
federally, it is.
Federally,
It's the
right,
biggest
yeah.
tax expense, bigger than the mortgage one. It's more than we spend on Medicare and Medicaid, but I'm just wondering what the,
Does anyone
at the
have that
state level.
information, or maybe?
Is it 32? 32, thank you.
uh,
Mr. Chair, and
Mr. Willett, what page number did we find?
page number 32? I was looking at item 32. Yeah, $1.4 billion in 2020 is the estimate.
thank you.
Okay. Anyone else? Members, thank you. There is Representative
Thank you,
Fabian.
Mr. Chair. And just real quickly, just this one family, and this is one of the smaller ones that I'm aware of, what's going on here with the 179, their total bill is just tick under $30,000.
Yeah, no, it's, we found out it's not necessarily a huge amount of people, but those that it impacts, it's significant. Absolutely. Representative Erickson.
Thank you, Mr. Chair. As long as Ms. Bear is here, I want to switch to the local option sales tax audits. So when an audit is done, because I've had them done in my district, and there's discovery that the business did not collect, and a bill then is submitted, how does the business repay that? I mean, what is the process? I have a business that was told by revenue that they owe $30,000. How is that transacted with the Department of Revenue?
Representative Erickson, we're getting a little off track here. And if
Well,
we-
she was at the table.
I understand, but if we want to talk about audit, I think it would be fair to maybe, tell the Department of Revenue. Ms. Bear, if you want to answer this, but, maybe, we can get the information another way, but if you can answer, feel free.
Mr. Chair, Representative Erickson, so when someone is assessed an audit, they'd be sent a notice similar to our adjustments when we send them a notice. They would have a chance to, in the 60 days, to pay in full without the interest. After that, we would send them a bill, and they can contact us and work out some payment arrangements if they can't pay in full. So I'd encourage them to contact us and we're more than willing to help and work with businesses that can't pay that full liability.
Thank you. And going back to section 179, a couple Fridays ago, I did go to Wilmer and met with Representative Baker and Representative Paul Anderson. They had a meeting with farmers, implement dealers, accountants. And from that meeting, there's going to be another bill introduced that actually came out of that meeting that is somewhat in between House File 3023, which we heard the other day, and the full conformity. It would actually look at full Section 179 on just the like-kind exchange. So again, it's depending on what type of a target we get, but it'd fall somewhere in between. But that was a suggestion that actually came out of the Wilmer meeting. So so there will be actually one more day. Representative Swedzinski's got a bill that deals with carry forward on Section 179. We'll be hearing that bill and probably this other one also. So we are going to actually have another day when we talk about Section 179. Representative Fabian.
Thank you, Mr. Chair. Would the bill that you're talking about, would that be retroactive too then, like the previous one that you did?
Representative Fabian, yes, I
Thank you.
forgot to mention that. Yes, it would be retroactive. All right, anything else? Members, because we worked so hard today, I'm giving everyone off tomorrow, the day off tomorrow. And so with that, we'll see you back on Thursday. We are adjourned. Thank you.